Welcome to the Ellsworth Advisors March update. I'm Kelly Keenan. This is Cameron Mealy. And today we're going to discuss what was going on in the markets and the economy through the month of March, which was obviously pretty exciting for about a week there. So Cameron, you're going to kick off some economic numbers, and I'll jump into what happened in the portfolios, and we'll discuss what's been happening. Cam?
Perfect. Thank you, Kelly. Good afternoon, everybody. Over the last couple of weeks, we've had really two big pieces of economic data, economic news, really. Number one is not surprising. It looked like maybe the Fed would pause on its rate hike, but ultimately on March 22nd, the Federal Reserve Bank did decide to raise its target interest rate by 25 basis points. And, really what that means now, we've had 9 straight Fed meetings with 9 straight increases. The Fed target rate has now increased 475 basis points since March of 2022. And really, every either tightening or loosening scenario with the Fed is unique. But with this rate hike approach they've taken now, this really goes down as one of the most aggressive rate hike histories in the Fed's 100-year history. So obviously, unprecedented times with the inflation, calls in the Fed's mind. I really do think that they have, particularly Jerome Powell, the chairman of the Fed, has taken it as their personal mission. I think they feel some responsibility for the easy money policy and where inflation has gotten to, and they certainly are committed now to bringing it down, no matter what they need to do. Ultimately understanding that might harm the overall economy, that might harm the consumer, but they really see it as their mission now is to get inflation under control.
I'd say it's really about not making the same mistakes that were made back in the 70s.
Yep.
Is really what it's about. And there's starting to be, this inflation obviously has come off its highs,
Yep.
which is good, but still
my thunder.
But still higher than where they want it to be, which Cam will discuss. And the other reality is the Fed uses a consistent set of data, but there's obviously a lot of different ways to measure inflation and frequency of it. So the Fed uses their data based on the methodologies that they've been using for, the last several decades, and other sets of data, which may be a little bit more timely or more short term. There are signs that inflation has started to recede, so that's a good sign. The key is the Fed doesn't want to act too soon, which is what happened in the 70s. Data would look better, they'd cut rates, and then all of a sudden inflation would fire up again. And obviously they're trying to avoid that at this point in time.
And if it really, from a calming standpoint, from a confidence standpoint, they cannot appear reactionary. This
Correct.
Has to look like very well thought out, which it is, but very well thought out, very methodical. We follow the data. We don't follow what happened last week. We follow the trends in the data. And, speaking of that, on March 31st, the Bureau of Economic Analysis released their February personal consumption expenditure index. That is one of the major indexes that the Fed does rely on for inflation data. And good news for the market, the February year-over-year increase came in at 5%. And if you look at the trend since October of 2022, personal consumption expenditure index came in at, and these are year-over-year increases, 6.1%, 5.7%, 5.3, 5.3, and February's 5.0. So obviously the trend looks good. The market was very excited by that report. We've had, a strong increase in the stock market since that report. And so I think the hope is obviously that inflation is now under control. We are seeing what feels like a slowing down of the economy. We are seeing capital come out of the markets. We're seeing the higher interest rates, take business inventory investment, take consumer investments, consumer free cash flow out of the market, which certainly means demand should soften, which certainly means that inflation, should come down.
That is a theory. Slow down economic activity should ease inflation pressures, and we might as well jump right into it. Prior to them raising rates, we had the banking issue with Silicon Valley Bank, Signature Bank, where both those banks, you could call it, poor management. They did not have very diversified loan portfolios nor diversified deposit bases. how their risk management was, or how their balance sheet risk management was handled was poor, and the rising interest rates hurt them badly, both banks. And really, there was an old-fashioned run on the bank where depositors started withdrawing funds at a rapid pace, which, that's kind of key to banking. Is the assumption is deposits will stay there, so you can lend longer term on shorter term deposits because people generally keep money in the bank, and a lot of their customers had a lot more than just the $250,000 that's guaranteed by FDIC insurance, caused a run on the banks, and ultimately led to those banks' failures. We also saw Credit Suisse in Europe. Same type of scenario, but I will caveat Credit Suisse
they've been in trouble for a long time.
They've always been on the verge of having issues, especially going back to 08, 09, and they've managed to survive. This time they did not, and all their assets were absorbed by UBS, and Credit Suisse will no longer be talked about. Let me put it that way. So, the banking situation, definitely in this environment, higher interest rates, that stresses the banks, but it's a stress that they can handle. And the other reality is if the economy is going to slow, that's going to put pressure on their lending. They're going to be more hesitant to lend. So the reality is banks are going to be going through a difficult period. I don't think they're not going to go out of business, but the reality is banks aren't going to earn as much as they did. We're probably going to see reduced earnings for a decent period of time here before banks become a good place to invest dollars, buying their stock, buying their bonds, and so forth. But it's just not going to be a very robust area. And it makes sense.
Their net interest margin is compressed in these times. What's important for people to remember is the U.S. economy, the U.S. financial system is not falling apart. We've had two isolated banks that made very risky investments when times were good, and they got hurt when times were bad. You look at your regional banks, you look at your large money center banks, everybody I hate to say this with a certainty, but everybody learned a lot of lessons during the financial crisis.
Oh, absolutely.
Internal controls at banks they are looked at as the stalwarts of the U.S. economy.
Right.
As the trusted financial centers for consumers and business. So there's much more government oversight. The risk departments at those banks are gigantic now and very committed to what they do. So this creates a pain, but the U.S. financial system, i.e. the commercial banks, are going to be just fine. It might not be great investments, but they're not going.
Well, I agree. And if you think about it, in a low interest rate environment, it's harder for banks to earn that net interest margin. So we had such an extended period, banks had to get more aggressive with their lending. And now in a higher interest rate environment, which should be more beneficial to banks, they're paying the price a little bit to get earnings when things were, not the best environment for banks. They had to do things that put them at a little more disadvantage when rates are higher. And that's really what they're facing. I think the financial system is sound. It's going to be challenged. That's for sure.
And certainly the repercussions for consumers and for businesses are that banks are going to be more cautious when it comes to lending. Covenants, on business loans are going to be tighter. Leverage multiples are going to be tighter. And loans that looked at, maybe 2 years ago, this isn't something we really typically do, but this is a good customer, this is a good client, we're going to stretch for them. They're not going to be stretching right now.
Right.
There's going to definitely be a pullback in the availability of money.
Absolutely. And the banks that, bought those loans, obviously they bought them at good prices. So, that kind of helps firm up the banking system a little bit. And the beneficiaries will probably be the big banks because they're the ones that are buying a lot of these assets. So that'll help them overcome, the challenges, moving forward. So that's kind of the thought process there. We don't have a lot of bank exposure. We do in our small cap portfolio. That's where we had some of the smaller banks, and as we talk about it, they got beat up pretty bad. But then again, none of them went out of business. It's just, once again, they're facing that challenge along with just the guilt by association.
Yep.
Everything went down. We've seen some recovery. Now the question is, what is the right share pricing for banks moving forward, or at least in the interim.
Yeah. All right, then last piece of information, we said the Fed really is focused. while they look at a lot of inputs and outputs, there really are two major pieces of information the Fed looks at: inflation and jobs. That's kind of their measure of the economy, the pulse of the economy. So, biggest economic information that we have, scheduled economic information we have coming up this week would be the March jobs report. That's going to be published Friday, April 7th. That's Good Friday, so we won't get any market reaction then, but we'll see how that report comes in. Obviously, if it's below forecast, certainly looks like the economy is slowing down. If it's above forecast, looks like the economy is staying strong. The underlying numbers and assumptions will play into the Fed's next rate hike or stand pat decision,
which is until May. So April is kind of a quiet month from that standpoint. The Fed's probably not going to do anything in May. I mean, in April, I'm sorry, unless it was a emergency situation. Probably see nothing going on with interest rates. Historically, April tends to be a pretty decent month. May is when things get a little dicey, and obviously, coming into May, we're going to have potential Fed another rate hike potentially in May, and then the one thing that hasn't been talked about, which I think will start hitting the financial press, and you'll start hearing a lot more about it in the news politically, is going to be the debt ceiling, which is June. Mm-hmm. So as you get real close to that, which obviously they're going to wait for the last second to do it, but there could be a lot of consternation about the national debt and raising the debt ceiling come May. So we'll be talking about that next month. So I'm going to leave it at that.
If it's typical bickering between Republicans and Democrats, it will create some volatility, and will
absolutely
create it'll create sensationalized headlines, but ultimately the U.S. government, the U.S. economy is not going bankrupt and out of business.
Right. It'll get done. It's just everything that's going to lead into it makes good ratings, and we're going to have a lot of that going in that time frame.
It'll be typical Congress acting like adults.
Okay, so with all the craziness that happened in March, the reality is the markets did well. For March, S&P 500 was up 4%. Dow Jones 1.87, less than the S&P. I think that's some of the financial exposure in the Dow Jones definitely hurt them. The Nasdaq up 7.4, so we saw a little bit of flight to quality in the largest technology names, Apple, Nvidia, those technology companies that have really strong balance sheets. The speculative tech names, not so much. Russell 2000, which is a small cap, broad-based small cap index, up 5.5%. Internationally, the MSCI, EAFE up 1.8, and then the emerging markets index up 1.05. Year to date, that takes the S&P 500 to about 7%. Dow Jones, which was slightly negative last month, has cracked into the positive, up 0.4%. Nasdaq has, through January and last month, strong months for the Nasdaq. That's up 16.8%. I don't know if that's going to hold, so we'll see about that. Russell 2000, 2.32, the EAFE 7.65, kind of in line with the Dow, so you're seeing a little better performance internationally. Emerging markets up 3.54. From our portfolio standpoint, growth with income portfolio, we're up 2% for the month. Year to date up 4.2, so pretty happy with that. Big gainers, I mentioned NVIDIA previously. They were up 20% last month. Lennar, our home builder, ever since midway through the year last year, it's been doing well. Last month up 8.67. Apple had a nice pop, up 12%. Pepsi up 5.75. Laggards, CVS down 11%. Nucor had a little pullback, down 7.4, and Digital Realty down 4.6. Year to date, big gainers. NVIDIA up 90%, crazy gains there, which we held onto a position there. Apple up 27%, Microchip Technology up 19.8, Nucor year to date still up 17.6, and Disney trying to crawl out of the hole, up 15% year to date. Big laggards, CVS down 19%, J&J down 11.6, Honeywell down 10, and then EOG, which is our natural gas exploration, down about 10%. So a little bit of surprise there from the gas standpoint. Dividend yield up 1% for March, so kind of a slow month. Year to date up 0.5%, kind of running in line with the Dow roughly. Big gainers, Southern Company up 10.3, Waste Management up 9.5, Edison up 7%, UPS up 6.3. So kind of the real defensives working in there. But laggard wise, we bought U.S. Bank down 23%. Too bad they didn't pop up a couple weeks later because we wouldn't have bought it. Prudential down 17%. Once again, issues around, what's going on with bonds and interest rates that hurts the insurance companies. Caterpillar down 4.5. Year to date, still Blackstone still leads the group, up 19.5. LyondellBasell up, which is a chemical company, up 14.5. Packaging Corp up 9.6. So pretty solid there. Laggards in here, Pfizer down 20.5. Obviously, U.S. Bancorp down 16. Pru down 15.8. 3M down 11. Appreciation with income. We don't have a lot of people in this portfolio, but I am going to mention it. I mean, this is where, having bank exposure, if we have bank exposure, it's definitely in here. March down 1.6%, year-to-date down just on, 0.9%. What works, Sanofi, which is up 16%. They're a pharmaceutical company. Dick's Sporting Goods up 11%. Restaurant Brands up 5%, American Tower up 3.2%. But once again, Bank of America down 16%, CVS down 11%, JP Morgan down 9%, and then Camden Property Trust down 7.8%. So we are seeing some stress in the real estate arena. And some of the talk is that could be the next area that the banks are facing risk in their real estate loans right now. Year to date, Dick's Sporting Goods up 18.8, Broadcom up 15.6, Public Storage up 9. Price potential, March, a decent month, only up 1.5% in March, but year to date, we're up 7.6 in there. So year to date, we're good. Just didn't have a stellar March, but still in good shape. Big gainers, Intuit up 9.5, Stryker up 9%, Boston Scientific up 7, PayPal up 3.2. Once again, Bank of New York Mellon, which is really a custody bank, down 10.7. There's kind of an example of guilt by association.
Yeah, they had nothing to do with what's going on.
The balance sheet is pristine. Agilent up Agilent down 2.6, Union Pacific down 3, Genpact down 2.9. Year-to-date leaders in this portfolio, Stryker up 17, Fiserv up 11.8, FleetCor up 14.8, Comcast up 9, Humana down 5%. Other positions that were down, we've stepped away from, so that's kind of where we stand for price in March. Our small cap portfolio, like I mentioned before, we have small bank exposure in the small cap portfolio is down 4.4% for the month. Year to date, down 2.5. Obviously the small banks, they bounce back some. We'll see how how this thing rebounds in April. Big gainers, preformed line products up 43.4% for the month. Lantheus, which we mentioned before, another big month there, up 11.6. PTC Therapeutics up 11. Windmark up 9.7. Here are the big down numbers for March. CVB Financial down 30. Titan Machinery down 33.5. Investar Holdings, which we did get out of yesterday, down 28%. Northeast Bank down 24%. Greene County Bank down 20%. So they got beat up, but not horrible. Obviously, none of them went out of business. Gainers, Lantheus up 62%. I mean, that thing was probably up 60-70% last year, so that thing's been just the gift that keeps on giving. Preformed line products up 54%. Windmark up 36%. PTC Pharmaceuticals up 27%. And for the year, Harmony Biosciences leading the losers, down 40%. Investar down 34%, and CVB down 35%, and Titan Machinery down 23.4%. So that's kind of where we're at. Once again, the numbers, midway through the month, you would have thought this was the beginning of the big one, and things kind of held up. The economy is slowing, but there's also areas of the economy that
make money in a slowing economy.
That are working. Obviously, leverage is dangerous when rates are going up and going into a slowdown. So our focus is, stick with quality, manageable debt levels. We don't use any leverage in the portfolio. Maybe we, kind of muddle through this, But, we have to assume at some point we get an economic slowdown and, maybe that final leg down in the market. But, we don't know if that's going to come. So we kind of have to stay invested, but just be in the right spots that we can kind of survive through everything. And that's where we stand today.
So with that, thank you very much for your time and for your trust. We'll talk to you again in April. If you have any questions, please feel free to reach out to us. Thank you.
Thank you.